Hello, dear viewers. Yes, it gives me great pleasure to address you all in this particular forum. We at NAFA Asset Managers have decided that we'll periodically address you uh, on various aspects of the market time and again. And this is our debut video. And around this time, I feel that it is imperative to address a topic that is favorite to me. I've written about this topic earlier, and I've addressed about this topic in various public forums. So this is about large caps versus mid cap, small cap. So at NAFA Asset Managers, we run the mid cap strategy and the small cap strategy. We don't have a large cap strategy. Given the way the markets have performed over the last, say, 5-6 years, and especially post COVID, of course, we have seen a healthy growth in the mid and small caps. And now it seems like as if, it makes sense to move asset allocation from mid and small towards the large cap category of the markets. This is like seems to be a very consensus opinion at this point in time. I just want to take a step back and reflect on the current large caps in India and whether it is really prudent to shift asset allocation from mid caps and small caps into large caps, and whether such a strategy will pay fruit over a long period of time. So firstly, the main reason for trying to move from mid and small cap to large caps seems to be the valuation. The valuations of mid caps and small caps have ballooned over the last 4-5 years. There's been a significant multiple, that is numerator re-rating, P multiple re-rating for various sectors in the mid caps and small caps. So this makes it feel like as if the large caps are inexpensive compared to mid and small caps. This may not necessarily be true, because if you dissect the large cap data, when I refer to large cap, I'm referring to the Nifty 50 constituents, which together generate almost $100 billion of aggregate profit after tax. So if you look at the large cap, and if you remove the financial services, which constitute almost 37% of the Nifty 50 index, then you will figure out that the large caps are not as inexpensive as what it is made out to be optically at the index level. So now let us look at each and every index constituent, I mean the industry level constituent, and question ourselves whether the large caps have the ability to kind of replicate the performance that they have done over the last so many years. Let us address the biggest sector first, banking and financial services. Dear friends, way back in 2010 or even before that, if I was an active fund manager, the only option that I had to play the non-lending financial service sector. That is, when I say non-lending financials, I'm talking about asset management, wealth management, low-cost broking, depository, stock exchange, registrar services. The only way I could play these type of opportunities was by taking exposure to private sector banks, because these companies had subsidiaries which were actually present in these segments, and therefore there was a scarcity premium that was available to these private sector banks for a long period of time. From 2010 till date, there have been numerous amount of listings that have happened in the non-lending financial service space. But if you look at the Nifty 50 index, especially on the financial side, there is hardly only two non-lending financial companies, which is basically SBI Life and HDFC Life. The rest of the players are all into the lending business. Globally, if you look at any index, DAX Germany, CAC France, FTSE UK, S&P 500 US, over the last 10-15 years, we have seen a structural fall in the weight of the financial services industry in the headline indices. So, for example, in Germany, the financial services weight has gone down and it has been replaced by the industrials. In US, the financial services weight has gone down and it has gotten replaced by technology. So, we are now in a situation where there is a significantly high weight of financials in the index. And the only way to play non-lending financial is when you move outside the index. So, if I'm an FII and if I had to play the broking, I did not have many plays. If I had to play wealth management, I did not have many options way back in 2010. But today in 2025, I have umpteen options just to participate in the wealth management segment, just to participate in the asset management segment. I'm not forced to be in a lending business, which was the case maybe 1.5 decades back. So this is probably one of the reasons why we have seen a healthy time and price correction in private sector banks. And even during the so-called recovery phase, they've not really outperformed as much as some of the other mid caps and small caps. Of course, over the last 1 year or so, there has been a relative outperformance. But if you were to take a three year, 5 year, 10 year, etc., there has been a significant underperformance. So when you invest your money in a Nifty 50 constituent, you are putting 37% of the money into financial services, and the evidence points out, as a nation, as we keep getting richer, the weight of financial services keeps coming down. So this is something that we need to be cognizant about. The next sector that I would like to speak about is the consumer. So the consumer sector in the Nifty 50 has almost a 10% weight. So this includes companies like Hindustan Unilever, Britannia, ITC, Dabur, Nestle, Titan, Tata Consumer, etc. These companies at this point in time have an aggregate PAT of around 50,000 crores, and today they demand almost a 25 lakh crore of aggregate market cap, which means that the starting PE multiple of the consumer companies were 50 PE multiple. So what is happening in the consumer space? Let us just take a couple of minutes to address this particular issue. The consumer companies were very strong franchisees. They had a very strong brand connect amongst the consumers, both on the general trade and on the modern trade. And the consumer companies derived extremely high bargaining power with their intermediaries, being the value chain, the distributors, the retailers, etc. So if the distributor or the retailer would not adhere to the conditions placed by the consumer companies, they would be easily replaced. So now we are now in a situation where things are changing a little bit after the disruption that is being given by quick commerce companies. These are deep-pocketed players, and they are having the ability to raise a lot of capital. Insofar, today a biscuit company or a chocolate company was able to push inventory and keep the working capital in the balance sheet of the distributor, whereas their own balance sheet used to be very light, and they used to pay their suppliers, the milk vendor or the maida vendor after 50-60 days. So the working capital was extremely light for the consumer oriented companies, and therefore they are enjoying a very high PE multiple. So now when you are looking at some of these consolidation that has happened in the distribution fraternity, where there has been an advent of many quick commerce companies, the bargaining power has now shifted from a consumer company into the distribution company. So a particular FMCG company cannot go to the quick commerce company and dictate terms saying that you need to stock 100 kgs of my biscuit, or you need to stock 200 kgs of my biscuit. So that's not going to happen anymore. The dark store is going to say that you please come and deliver it when I need it. Therefore, you're going to see the logistics cost of consumer companies inching up. And today, the quick commerce is now giving an even pedestal to a legacy 50, 60, 70-year-old brand, and probably a new D2C brand that is maybe 3 to 5 years old. So a legacy brand and a new brand are put on the same pedestal. Therefore, it is forcing these FMCG companies to invest more in brand building and logistics. One of the leading FMCG companies is now tying up with more than 10,000 influencers, and trying to build up their image amongst the Gen Z consumers. So whether these kind of valuations will sustain remains to be seen. This is as far as consumer is concerned. So we have spoken about financials, which is a 37% weight in the index. Now we have spoken about FMCG consumer, which is having a 10% weight in the index. So 47% weight in the Nifty 50 seems to be having these issues. Then the next sector, which has almost 11% weight in the Nifty, is the information technology sector. This sector obviously has the giants. You have TCS, Infosys, HCL, Wipro, Tech Mahindra, etc. So these have been extremely good wealth creators over the last 15-20 years, but now there seems to be a significant amount of headwinds. So the skeptics would say that these IT companies have already seen many such headwinds in the past. It can be Y2K, or it can be the great financial crisis, or it can be COVID, and they've always come out stronger. But this time around, it seems that the AI phenomenon is not just a passing cloud, but it is here to stay. Over and above that, we are also seeing a situation where there has been an umpteen amount of GCCs who are setting shop in India, especially in cities like Bangalore, Hyderabad, Delhi, Chennai. India is now home to almost 2,300 GCCs. And I just read this today that Rolls Royce is setting up its own GCC. So, you have a situation where at one point in time, these GCCs were cost centers, they're now becoming profit centers. So, the hiring, today, the cream de la cream of the engineers would probably prefer to work in a GCC than go to the traditional IT service companies. So, which means that the traditional IT service companies have to put up with average or above average talent, and the burden is upon them to upgrade their skills. That is point number one. Point number two, in terms of automation, especially while going for deal renewals, the clients are questioning as to why that they should be paying this amount of billing rate per hour. Why can't the IT service company use AI to automate and reduce the number of manpower? And therefore, you are seeing volume and value pressure as far as IT service companies are concerned. So this is again proving to be a bit of a challenge. The earlier challenge used to be rupee appreciation and so on and so forth, but these are just passing clouds. These companies have seen umpteen amount of currency movements, and they've come out very strong. But this time there seems to be a structural problem as far as IT is concerned. So when you are investing your money in Nifty 50, you are indirectly investing 11% of your money in IT sector. So 37% financial services, 10% consumer, that is 47, and 11% IT, that is 58%. So 58% of large caps is facing this kind of an issue. Then let us talk about another sector which has a 7% weight in the index, which is the auto industry. Now, when you're talking about auto industry, there is four-wheeler and there is two-wheeler. Let us talk about four-wheelers first. In four-wheelers, you have Maruti, Tata Motors, M&M, and in two-wheelers, you have Bajaj, Hero, TVS, and Eicher. So, in the case of four-wheelers, in the year 2008, 3 out of 4 cars that were sold in the country was a hatchback. It was a small car. In the year 2025, 1 out of 4 car that is getting sold in the country is a SUV or a mini SUV, meaning that the customer, as the income levels start inching up, we might say that the overall per capita income of India is barely $2,200, which is about 2 lakh rupees. But if you look at the urban per capita income, the per capita income in Bangalore is probably 10 lakhs. The per capita income in Gurgaon is probably 11 lakhs. The per capita income in Chennai is probably 8 to 9 lakhs. So as the income levels have gone up, what people used to buy as their third car in their career is today their first car. So people are going for more safety features. People want more comfort. They want to go from Bangalore to Goa. They are wanting more features, more safety, and they are willing to pay more for it. Today, you have 2/3 of the nation buying SUVs and mini SUVs. So when the market has a perception that the leader is into SUVs, is into hatchback, what will happen to the future growth is something that we need to ponder about. Today, while the base is still low, many of the unlisted auto companies, such as Kia, BYD, MG, and in the premium segment, maybe a Mercedes, they are all growing faster than the incumbents. So that seems to be a bit of an issue that we need to be cognizant about. So today, a youngster would want to be seen driving a MG or a BYD or any of these other newer cars, the newer models, than the legacy brands. Now, coming to two-wheelers, two-wheeler is a classic case of an oligopoly market. You had 4 players: TVS, Bajaj, Hero, Eicher. Now you probably have 15 to 20 players. You have Ampere, you have Joy e-bikes, you have Ultraviolet, you have Ather, you have so many players, you have Ola. Whether they make money or don't make money is another issue. But when the market has a perception that the incumbents can lose market share, that itself is enough for a significant amount of time correction as far as the stocks are concerned. So this is again another problem with the auto industry. Friends, we have addressed 2/3 of the entire Nifty having these problems. The rest of the Nifty is left with oil and gas, pharma, cement, metals. which will constitute the balance 30 odd percent. So this 30 odd percent alone need to pull the index higher, which is a Herculean task. Another aspect which I would like to touch upon is the fact that what are our unlisted companies doing? It's not as if large caps are not growing. Large caps are definitely growing in India. The problem is the listed large caps are not growing. The unlisted large caps are growing. So let me give you an example. If you take Apple, Apple in India has grown by 13%. So what does it mean? Today, Apple's turnover is 75,000 crores. This is the turnover of Apple, where people go to Apple stores in India or various dealerships in India and buying the phones. That turnover alone is 75,000 crores. So what is 75,000 crores? 75,000 crores is greater than the turnover of Sun Pharma, Cipla, and many other legacy companies in the Nifty 50. It's just that Apple is not listed. Today, YouTube alone generates almost a 20,000 crore turnover. This is more than Sun TV and Z put together, which are the largest two general entertainment channels in the country. Today, your Microsoft is having a turnover of 30 to 35,000 crores. Amazon, Alphabet, all these companies who have their subsidiaries in India, although their numbers, when you compare it to the parent, may be a rounding off error, but as far as India is concerned, it's a huge number that we are talking about. So large cap growth in India is happening, but the point is the large cap growth is happening outside the Nifty 50. Now coming to mid and small caps, way back in 2000, these were uninvestable because of few reasons. There's a huge unorganized sector, lack of corporate governance, and you really don't know what you're getting into. But now we are seeing that the after the implementation of GST, it is very difficult to be non-tax compliant. And now after very many reforms, most of the unorganized is moving to organized. So you are having a situation where mid and small caps, there are more new listings that are coming to the mid and small caps, and there seems to be many more opportunities in the mid and small caps. Of course, these are volatile, these can be a little illiquid, and these can fall more in a corrective phase more than the large cap. All that is a given. But structurally, you are better off continuing to be in mid and small caps if you were to take a 5-year view or a 7-year view. And that is what we at NAFA Emerging Blue Chip are trying to impress upon our audience. I hope this was useful for you. Thank you so much for listening. Thank you.